The return of the gold question. In 1971, US President Richard Nixon closed what was known as the gold window. From that moment, the dollar was no longer convertible into gold at a fixed price, and the world officially entered the era of fiat currencies, money backed not by metal, but by trust in governments and institutions. For decades, this system defined global finance. But today, the question is returning. Could gold once again play a central role in money? The renewed discussion is not about nostalgia. It reflects deeper uncertainty about how stable our current financial structures really are. Why the topic matters again. The interest in gold's monetary role has not appeared randomly. It has been driven by waves of inflation, aggressive monetary policies like quantitative easing, and growing geopolitical tensions. When economies become unstable and confidence in currencies weakens, people naturally begin searching for alternatives. Gold re-enters the conversation because it exists outside political control. It cannot be printed, diluted, or digitally created. That independence makes it both attractive and controversial. As uncertainty rises, the idea of gold as a monetary anchor starts to feel less theoretical and more practical. Aim of the discussion. This presentation does not try to glorify gold or criticize modern finance. Instead, it aims to understand the real picture. What role could gold realistically play today? What do historical data, expert opinions, and financial trends tell us? We will avoid myths and emotional narratives and instead focus on facts, numbers, and scenarios. Because the key question is not whether gold belongs to the past, but whether it still has a place in the future. Understanding that requires context, history, and a clear look at how the financial system actually works. Keynes. Gold as a barbarous relic. One of the most famous criticisms of gold came from economist John Maynard Keynes, who called the gold standard a barbarous relic. His argument was simple but powerful. Tying money strictly to gold made economies rigid. Governments had less flexibility to respond to crises, and deflation could become severe. In Keynes's view, modern economies needed adaptable monetary tools, the ability to adjust interest rates, manage liquidity, and stabilize growth. To him, gold represented stability, but also limitation. Greenspan, gold and freedom. On the opposite side stood Alan Greenspan, long before he became chairman of the Federal Reserve. In his early writings, he argued that gold was deeply connected to economic freedom. According to this perspective, gold limits political power because it cannot be created at will. Governments cannot inflate it and therefore cannot easily erode purchasing power. Supporters of gold see it as a safeguard, a protection against irresponsible policy and currency devaluation. In this view, gold is not restrictive, it is protective. De Gaulle's position? Between these two extremes stood Charles de Gaulle, the French president who challenged the global monetary system in the 1960s. He believed gold should remain the ultimate anchor of value. France even began exchanging US dollars for physical gold and transporting it back to Europe. This was not only an economic move, it was geopolitical. It reflected concerns about dependence on another country's currency. These three perspectives, Keynes, Greenspan, and de Gaulle, still define today's debate. Is gold a relic, a safeguard, or a strategic tool? The answer depends on how we view power, stability, and trust in the monetary system. Models of a gold return. When people ask whether gold could return as the foundation of money, the first important point is this. There is no single model. A return to gold could take many forms. One possibility is the classical gold standard, where banknotes are directly convertible into a fixed amount of gold. Another is the gold exchange system, similar to Bretton Woods, where one currency is linked to gold and others are tied to that currency. There are also modern ideas such as using gold as a policy reference, a benchmark to guide inflation targets without full convertibility. And some economists propose a commodity basket where gold is combined with other resources to stabilize purchasing power. Each model represents a different level of commitment and control. Alternative structures. Beyond traditional models, there are more radical possibilities. One is free banking with gold backing, where private institutions issue currency linked to gold instead of relying on central banks. Another idea is a more market-driven system, where gold acts as a competing form of money alongside national currencies. In such scenarios, central banks would have less control, and financial systems would rely more on trust, discipline, and competition. These approaches challenge the modern structure of money, but also raise questions about stability, regulation, and risk. Implications of each model. Every model of returning to gold comes with consequences. Economically, it could reduce inflation risks but limit policy flexibility. Politically, it could shift power away from governments and toward markets or physical reserves. Operationally, it would require new systems, audits, and coordination. And financially, the transition could be expensive and complex. That is why discussions about gold are rarely simple. They are not only about metal, they are about how societies organize money, power, and trust, gold coverage, and money supply. One of the most revealing questions is this: what would it take for gold to fully back modern money? The United States holds about 8,133.5 tons of gold. That sounds like a huge amount, and it is. But when compared with today's money supply, it becomes clear how different the modern system is. To support all circulating money, gold would need to be valued at dramatically higher prices. This highlights the scale of change between past monetary systems and today's financial reality. Estimated gold values. If gold were used to back the full US money supply, estimates suggest prices would need to reach around $84,000 per ounce. Backing only the monetary base would require roughly $22,000 per ounce, and covering only physical cash in circulation would imply around $9,000 per ounce. These numbers are not predictions, they are illustrations. They show how far current financial systems have expanded relative to physical gold reserves. Money has grown faster than the metal that once anchored it. Meaning of these numbers? What do these figures really tell us? They reveal the difficulty of returning to a fully gold-backed system. The transition would not be simple. It would require adjustments in prices, policies, and expectations. But they also highlight gold's monetary significance. Even today, gold remains a reference point for value. It exposes the imbalance between physical resources and financial expansion. And it reminds us that money is not only numbers, it is a structure built on trust, scarcity, and credibility. Global gold supply. To understand the monetary role of gold, we must first understand its physical reality. The total amount of gold ever mined in human history is estimated at roughly 212 to 216,000 tons. That may sound enormous, but when compared to global wealth and financial assets, it is surprisingly small. Each year, mining adds only about 3,000 tons. This slow growth means the supply of gold increases gradually and predictably, unlike paper money, which can be expanded rapidly. This natural limitation is one of the reasons gold has historically served as a monetary anchor. Gold as hard money. Gold has characteristics that make it unique among financial assets. It is rare, durable, and portable. It cannot be easily destroyed, and it does not depend on any government or institution for its existence. For centuries, these qualities made it ideal as hard money, a form of value that cannot be inflated or manipulated easily. People trusted gold because it existed outside political systems. It did not promise value, it was value. That distinction shaped its role in global trade and finance for generations. Supply versus money supply. Now compare that limited gold supply to modern money creation. Global financial systems have expanded dramatically, with digital money, credit, and derivatives growing far faster than physical resources. This imbalance explains why gold retains monetary importance. Its scarcity reinforces its value. It reminds markets that real assets have limits, and it provides a counterweight to financial expansion. Gold's role is not about replacing money, it is about anchoring it, reminding economies that value cannot grow infinitely without consequences. Lessons from history. History offers some of the clearest insights into gold's role in finance. Again and again, during major economic shifts, gold has returned to the center of the system. It has financed governments, stabilized currencies, and influenced global trade. Its importance rises during uncertainty, wars, depressions, inflation, and financial crises. This pattern repeats across centuries, showing that gold is not simply a commodity. It is a strategic asset that societies turn to when stability is threatened. Key historical events. Several key moments illustrate this. The Gold Reserve Act of 1934 centralized gold under U.S. government control, strengthening national reserves during the Great Depression. The Bretton Woods system linked global currencies to the dollar and the dollar to gold, creating decades of relative stability in exchange rates. Then came the Nixon shock in 1971, ending convertibility and ushering in the modern fiat era. Afterward, inflation surged until strong monetary policies eventually stabilized prices. Each of these events reshaped the global financial order, and gold was at the center of every transition. Gold in crises. One lesson stands out clearly. During crises, gold reappears as a stabilizing force. It acts as a reserve, a hedge, and a psychological anchor. Investors trust it because it is not tied to a single government or currency. Central banks hold it for the same reason. It provides independence and credibility. Across generations, gold has maintained that reputation. And while financial systems evolve, this core behavior remains constant. When uncertainty rises, attention returns to gold. Modern gold scenarios. If gold were to play a larger role in the future monetary system, it would not necessarily look like the past. Economists and policymakers have proposed several modern scenarios. One idea is to use gold as a reference indicator, not as a currency itself, but as a benchmark for inflation and stability. Another concept is a Bretton Woods 2.0, where global financial systems integrate gold into a new framework alongside digital settlements. There are also models where countries could adopt domestic gold-linked pricing systems while maintaining flexible exchange rates internationally. And in more market-driven visions, gold-backed financial instruments could compete directly with fiat currencies. Each scenario reflects a different balance between control, flexibility, and stability. Digital era integration. Today's financial world is fundamentally digital. Payments, settlements, and transactions occur instantly across borders. This opens the door for hybrid systems where gold and digital currencies coexist. Central bank digital currencies, stablecoins, and blockchain infrastructure could operate alongside physical reserves. In this layered system, gold might serve as the ultimate reserve asset, while digital tools handle daily transactions. This combination allows efficiency without losing a long-term anchor of value. The future may not be gold versus technology, but gold with technology. Policy challenges. However, implementing such systems would not be simple. Political resistance would be significant. Governments may hesitate to limit monetary flexibility. Financial institutions would need new regulations and infrastructure, and economies would need to adapt to new risk structures. Any move toward gold would involve trade-offs: stability versus flexibility, discipline versus control. The discussion is not just technical, it is deeply political. Money is power, and changing its foundation changes how that power is distributed. Operational challenges. Even if societies decided to move toward a stronger gold-based system, the practical challenges would be enormous. First, there is no universal answer to how much gold is enough. Different economies have different sizes, needs, and monetary structures. A fixed system would also require adjustments through wages and prices rather than through currency depreciation. That can create economic rigidity, especially during recessions. The idea may sound simple in theory, but in practice it requires complex balancing. Geopolitical factors. Gold is not only financial, it is geographic. Physical reserves are stored in specific locations, often in a few major financial centers. Access, control, and political relations become critical. International tensions could influence who holds reserves and who can access them. This makes gold part of global power dynamics. A gold-based system would not eliminate geopolitics. It would likely intensify it. Countries would compete not just for economic influence, but for physical reserves, transparency, and costs. Another major issue is transparency. Modern financial systems require trust, and trust requires verification. Auditing reserves, maintaining security, and building infrastructure would all come with costs. Technically, transitioning toward a stronger gold framework may be possible, but politically and economically it would be challenging. The gap between what is technically feasible and what is realistically achievable remains one of the biggest barriers. Gold may be simple as a metal, but complex as a system. Historical case studies. History gives us valuable insight into what happens when societies try to reconnect money with gold. One well-known example comes from Winston Churchill in 1925. When Britain attempted to return to the gold standard at its pre-war exchange rate, the move was symbolically powerful but economically painful, leading to deflation and pressure on wages and employment. Decades later, in the early 1980s, the Reagan Gold Commission in the United States explored the possibility of restoring a gold-based system. After extensive analysis, the proposal was ultimately rejected, not because gold lacked value, but because the transition would have been politically and economically difficult. These cases show that gold has never disappeared from the conversation. It continues to return whenever monetary stability is questioned. Impact on society. A gold-based system would affect every level of society. For households, it could mean stronger long-term purchasing power and protection against inflation. But it could also bring sharper adjustments during recessions, as prices and wages would need to respond more directly. For businesses, reduced currency volatility could improve planning and international trade, but tighter credit conditions might limit expansion. Governments would face stronger fiscal discipline, with fewer options to create money during emergencies. And global trade could become more stable, yet more competitive, as countries manage physical reserves. Economic trade-offs. No monetary system is perfect. A stronger gold role could reduce inflation risks but limit flexibility. Credit cycles might become less extreme, but financing growth could be harder. Economic adjustments could become slower and more visible. Policymakers would lose certain tools while gaining others. The key idea is balance. Gold introduces discipline, but discipline always comes with constraints. The challenge is finding a system that preserves stability without blocking growth. Future role of gold. Looking forward, it is unlikely that the world will simply return to a 19th century gold standard. The modern financial system is too complex, too global, and too digital. But gold could still play a central role, just in a different form. Many experts envision hybrid systems, where gold functions as a reserve core while digital currencies handle transactions. In this scenario, gold would not replace money, it would stabilize it. Its presence would signal discipline, credibility, and long-term value. Message for investors. For investors, the message is already visible. Central banks continue accumulating gold reserves. Policymakers still reference gold during discussions about stability. Financial markets treat it as a safe haven in times of uncertainty. Gold has not disappeared and it has adapted. It no longer defines everyday transactions, but it remains an anchor beneath the system. This is why many long-term investors view gold not as speculation, but as protection. Final perspective. Ultimately, gold's importance is not about price alone. It represents trust across time. It connects past monetary systems with future financial innovations. It reminds us that value is not only created by policy or technology, but also by scarcity and credibility. In a world of rapid change, gold remains constant, not as a relic, but as a reference point. a golden compass guiding financial thinking in uncertain times.